3,500 transactions in 6 years?
Yeah, we do. The company itself does a little over 4,000 a year.
Yeah, so I get this. This is one of my top three questions for sure. Most of my clients, they call me, let's just say they had $1 million sale and 700,000 of that was equity and the rest was debt. A lot of times they have the misconception that they just need to reinvest the 700,000, that they just need to take that equity and reinvest it. They don't understand that you will actually have to pay capital gains tax on any debt that you don't replace on the purchase. So the rule goes like this. Any debt that's paid off at the close of escrow on the sale needs to be replaced on the purchase. Now, that can be replaced with cash if the clients have it, but the value of the debt needs to be replaced. And more often than not, I would say 95% of the time, they're going to go get a new loan.
Okay, just explain what you just said. It can be replaced with cash. What does that mean?
If they have cash from another source, like a savings account, or they get, I don't know, a hard money loan, a personal loan, they can bring that in and use that instead of getting a new loan, like a new mortgage, or they need to get a new mortgage. Well, this is an interesting question. So, and I get this question every day. So, as the qualified intermediary, the reason we exist is because the money cannot go to the taxpayer's personal account. That's a taxable event, right? So, at the close of escrow, the wire instructions will send that money to a company like ourselves, and we hold that money until they're going to purchase a replacement property. So, we are holding that money for anywhere between 1 day, maybe even the same day we're wiring to replacement property, but 0 to 180 days. They have 180 days maximum to close on that replacement property. Now, we do, like I mentioned, over 4,000 exchanges a year. So we do a lot of exchanges. And what we've learned over 25 years of being in business is that transparency is really important and also low risk. So what we do is the money goes into a special holding account at the bank that is created sole and separately for each of our taxpayers. So they have their own FDIC insured account. We hold a fidelity bond and E&O insurance as well. And that money is not invested. That money just sits there until they're ready to ready to buy their replacement property. It is also a bankruptcy remote entity, meaning if this company goes bankrupt, their money is not at risk because of that bankruptcy. So the money is at the bank, sole and separate from our company. And we do that because 25 years of being in business, we just want the lowest risk possible for our clients. And that's why we have chosen to model our business like that. And we use big banks. Right now, we're using Capital One, and they're a very large institution, and we think there's a lot of safety in that. Right. The 1031 exchange is for real property, which is described.
If you have rental property, you can buy commercial property. It just has to be property.
Correct. Yeah. So like kind, the definition is really broad. It's the qualified use of the property for investment or business purposes. Meaning if I have a client that sells a condo, they buy a single family home, and it's as long as it's a rental, it qualifies. They can buy commercial real estate. They can buy land. They can buy
How about vacation rentals?
They can buy vacation rentals. Yeah.
In a vacation rental, you get to use it too, but it's still an investment property.
And there are restrictions on personal use. It's 15 days per year that you're allowed to use it personally. And everything else has to be investment. People always ask about the California Franchise Tax Board. They ask, if I exchange out of state, do I get to take California tax money with me? And the answer is yes. There is a clawback provision that's for California taxpayers, meaning if you defer your taxes out of California, you have to, of course, report to the Franchise Tax Board every year that those funds are still tax deferred. But let's just say you sell that property in Texas down the line, you do have to end up paying those taxes to California at that time if you don't do another 1031 exchange.
So normally escrow has to hold back a percentage of the sale. Do they not have to do that when there's a 1031 exchange?
Correct. Yeah. So if you're doing a 1031 exchange, you'll check a box saying that you are doing a like kind exchange, and they will not withhold the typical 3 1/3%.
So you're saying 20 years later you sell it and you take all the cash, you're supposed to call back California and say, oh, by the way, I think I might owe you some money?
Yeah, you won't have to call them back. They'll call you. But
how will they know?
The reporting form that you file at the end of every year, when you sell that property and don't file that reporting form, they will know that you now owe those taxes.
Oh, Big Brother's always watching.
People want to know, okay, what's the minimum amount of real estate I have to buy for full tax deferral? I don't want to pay $1 in taxes. And the answer to that question is going to be sale price minus those non-recurring closing costs. So escrow, title, brokerage commissions, hour fee, all those fees, those get deducted. That's your net replacement value. Now, if you decide I'm going to buy something $50,000 under the value, you would only pay prorated taxes on that $50,000. So we have a lot of clients. They say, hey, I want to travel. I want to pay off a car, some credit cards. They can take some taxable funds and just pay taxes on it and use that cash however they want. And it's prorated, which is nice for some investors.
Well, that's cool. So you can still take some of it, pay tax on it, keep it, and do what you want to do, and shelter the rest in a 1031. Is that the right term? Shelter the rest in a 1031 exchange?
Right.
IRS doesn't like the word shelter, but that's what it is. It's sheltering your the taxable income that you would have normally gotten.
Exactly.
So tell me what fees are involved with a 1031 exchange.
So we operate off a flat fee basis, regardless of the value of the property. It's going to be $1,250 for one sale and one purchase. And if you decide to diversify, purchase multiple properties, we would just charge an extra $350 for each additional replacement property.
If somebody wants to do a 1031 exchange, how do they start?
Give me a call and just tell me about your transaction. Figure out, let me help you figure out if it's the best option for you, if it makes sense, for your goals, for your investment goals. It's pretty simple. Once you're in escrow, that's the latest time to contact us. We have to have the exchange agreement set up before escrow closes. like I mentioned, with the taxable event is when that money goes to your account. So if that money needs to go from escrow at the closing to the qualified holding account. If it goes to you, it's taxable event and it's too late, and that's the worst phone call I can get.